some background. So today we have a talk by Florian Wagener, who is, if I'm correct, by background, more of a mathematician really, but slowly made the transition to more economic topics, and has been at the UvA since 1999, and also worked in Warwick in the maths department, if I'm not mistaken, and Groningen before that. And he'll tell us about how good risk management can cause financial crises. Please go ahead.
Yeah, thank you very much, and thank you very much for the invitation. I'm very happy to speak here, and I hope you forgive all my minor and major inaccuracies. Now, the first thing I have to get out of the way is I'm going to talk a lot about financial instruments and about the downsides. But the first thing I have to explain is what they are there for and why is it a good idea to have them around. And it's all about risk reduction, financial risk reduction. And the classical example is ship owning. And that is actually one of the first areas where there have been financial instruments, and dates back to the Middle Ages and probably, though we're not certain, even to antiquity. So assume that you've got 3 ship owners, and every ship owner owns a ship, and this ship goes on a sea voyage, and it has a probability of 2/3 that it's going to come back safe and sound. Now, if you assume that the gain from a ship that is coming back is 1, then you can compute the gains and the losses, and the expected gain from these voyages. 2 ships are coming back, 1 ship's not coming back. Is here normalized to 1, but the risk is 2. Now, if you then cut up the ownership of each of the ships into 3 shares, and each of the ship owners owns 1/3 of each ship, then you've got the same expected gain. If the ship comes back, it pays 2. You've got the same expected gain, but the risk is then reduced to 2/3, and that's the whole principle of insurance. And the only event where you really will have losses when none of the ships are coming back, and then everyone loses. But there's a region where there's no profit been made, but most of the times there's a profit to be made here. Now, that is the general idea why you want to use financial instruments, and people in finance are very proud of these things. So this is Robert Shiller, who got the Nobel Prize for economics 10 years after he wrote this. Our fundamental risk will be insured against, hedged, diversified, or different words for the same thing, making for a safer world. By lightening the burden of risk, a new democratic finance will encourage all of us to be more venturesome, more inspired in our activities. You have to remember he's an American. But this is, or has been, the prevailing attitude up till the financial crisis of 2008, of course, with most experts, that financial instruments are generally are almost always a good thing. Alan Greenspan, who was the chairman of the Fed in those days, as is generally acknowledged, development of credit derivatives has contributed to the stability of the banking system by allowing banks, especially the largest, systemically important banks, to measure and manage their credit risks more effectively. There was only one dissenting voice who, before the financial crisis, was, well, he wasn't a former economist. Of course, he knew about finance, but this guy had this to say. And it's very important because he got the problem nailed on. Many people argue that derivatives reduce systemic problems, in that participants who can't bear certain risk are able to transfer them to stronger hands. These people, Shiller, Greenspan, believed that derivatives acts to stabilize the economy, facilitate trade, eliminate bumps for individual participants. On the micro level, what I say is often true. I believe, however, that the macro picture is dangerous and getting more so. The derivatives genie is now well out of the bottle. These instruments will almost certainly multiply in variety and number until some event makes their toxicity clear. Central banks and governments have so far found no effective way to control, even monitor the risks posed by these contracts. Any ideas? In my view, derivatives are financial weapons of mass destruction, carrying dangers that, while now latent, are potentially lethal. Warren Buffett. Warren Buffett is, of course, a private investor. Is not an official economist, but already in 2002, he knew exactly where the problem was. So on a micro level, this whole insurance story does work, but there's a macro side to the problem, and that was insufficiently captured in those days. And it, of course, blew out of control in the financial crisis. So what happened there? The financial instrument underlying that crisis, and there's usually, for every financial crisis, you can find a financial instrument underlying it, where the credit default swaps, which became extremely popular. And, well, the rise peaked in the end of 2007. And then, well, the financial crisis started to hit even more. And, well, I think we still remember what happened there. So apparently, this graph already suggests that there is some relation between these two graphs: the stock market graph, the S&P 500 index, and the volume of outstanding credit default swaps, which are instruments to distribute risk. So if the risk is so well distributed, why do we suddenly have a problem on the financial market? Now, since then, we've of course more data, and the use of these instruments went down and still is going down. They're still being used, but they're one of the instruments. And of course, the stock market has recovered since then. But here there was an enormous amount of action of central banks and governments to get things back on the rails again. Okay, so we set out to try to understand what has happened. Actually, when we're doing this research, it was before the financial crisis hit. So we always like to believe that if people just had listened to us, then none of this would have happened. I doubt it. It probably would have happened anyway, but we at least have found a mechanism to think about this. And this mechanism is based on the so-called Brock-Holmes asset pricing model. It's a heterogeneous agent model, and it's still our vehicle of choice to understand stock market dynamics. So let me take you through this model. You know, stock is just a piece of paper which gives you a right to dividend, which is paid out at certain points in time. You don't know what the dividend will be. There's no obligation to pay out a dividend, so it's an entirely uncertain income stream. Of course, you have got certain expectations about this income stream. So you can buy stocks. If you don't want to do that, you can also buy bonds. The bonds pay a certain interest rate. In this model, we assume that this rate is constant. Of course, we know it's fluctuating, but as far as this model is concerned, is that the interest which the bonds pay is extremely predictable. Now, if you want to buy a stock, you have to think about the value of the stock, and that is the expectation of your revenue stream, the dividends, and the value of that piece of paper when the firm which is associated to stock is liquidated. So that gives you kind of the fundamental value. Of course, no one knows exactly these numbers, so people have to estimate the present value. But there's usually quite a lot of work on that. However, in order to make good estimates about the expectations of the dividends and of the value of the company, that is hard. This is what is a lot of market analysts and banks are doing. It's called fundamental analysis. It's hard, and hard means in this context automatically that it's also costly. There's another approach, which is called technical analysis, which just says, well, we've got time series, so we can try to forecast the future prices from what we know from the past. And this is working so well that there are a lot of people doing this. If this wouldn't give you any returns, people would not be doing this at all. But there's lots of people also in banks who are doing these kind of things, more data driven. That means that the fundamental analysts have to take into account that the data they have on the values of stocks might be influenced by these technical analysts. Okay, so this is our basic model of the economic processes associated to stock market. We've got a stock market. On the stock market, it's basically a big bulletin board where prices are posted, and these prices change all the time. Prices are our data. These data are processed by the agents. The agents have a kind of a model how the stock market works. That's not necessarily the correct model, it's just their model which they're working with. They get the data, feed it into their model, whether it's an explicit model or just have it in their head, and then they decide on buying or selling. Now, to give an example, to come back to Warren Buffett, he once tried to build an artificial intelligent version of Warren Buffett. So he sat down with scientists and he told them, okay, I'm now doing this and now I'm doing that, and these are my reasons. And they tried to build this big AI system and let this AI system trade. Now, the interesting thing, what happened is that the AI Warren Buffett made a loss, where the real Warren Buffett made gains. So somehow there was something in his decision process which he couldn't formulate. He didn't know his own perceived law of motion. Okay. Anyway, you've got actions, buy orders, sell orders. They are brought to the market. They're buy and sell orders of all the market participants, which gives you the new market price of the thing that is traded, the stock, say, and that gives you new data points, and on it goes. So this part, the macro part, is the part which we see, which we've got quite a lot of observations about. The micro part is the part which we usually don't see. In some markets, we've got information about the actions, but we usually, what happens within the agents is a rather big black box for us. Anyway, this is the way how we think about the economy. Oh, by the way, if there are any questions, please interrupt me and pose a question. Okay. Now we have to model these things. So we have to model the micro level and the macro level. Now, in the micro level, we assume that traders have a kind of estimation method, a heuristic for forecasting the next period price. And that is based on the price data they already have. Why the next period price? Because the current period price is the price at which they are going to sell or buy the stock, and that one isn't known yet the moment they post their orders. But when they post their orders, they already have to have an idea what the stock will be worth the day after, because then when they're going to sell it again. Now, there are several heuristics, which I'm labeling here with an H for heuristic. And which heuristic are they going to choose? Well, this is based in this model on the past performance of the heuristic. And these models are quite common. They're used in many different contexts. They're also very flexible. So the model I'm going to write down is looking relatively simple, but because of this choice aspect, it's a lot less simple than meets the eye at first glance. Now, what do the traders try to achieve? Well, they try to maximize their future wealth, well, their risk-corrected future wealth. So this is the present wealth. If they put it all in bonds, then they get R times the present wealth. But if they take a little bit of the money not putting in bonds and buying shares instead, then they lose this amount in bond returns, but they gain this amount in share returns. This is multiplied by the number of shares, and then, oops, this last term here is the amount of risk, and it's typically modeled as a quadratic. So they try to maximize this quantity. It's just a quadratic function of z. So this is a not too hard problem to solve. Sigma here is the variance. And typically in these kind of models, we assume that everyone agrees about the variance. So the sigma squared doesn't have a subscript h. Everyone, the risk structure is common knowledge. It's just the price expectations that might be differing over different heuristics. Having maximized this, they get their demand schedule. And typically, the demand says, well, we compare the return or the expected return of the stock, and we compare it to the expected return of the bond. And if the expected return of the stock is higher, we want to have more of the stock, so the demand is going up. Whereas if the expected return of the bond is higher, then the demand for the stock goes down. If there's a lot of risk around, then we only trade small quantities, but if the risk is small, then we're going to trade really big quantities. That's the structure of this formula. Note, by the way, that the demand can be negative here. So you are allowed to go short on a stock. Now, this is the demand of every agent. On the macro level, we have to find out how many agents are using which heuristic. Well, the rule is we having these past performances. There's a cost as well. Some heuristics might be costly to compute. For instance, if you are computing the fundamental value of a stock, that takes you a lot of analytic work, and that has to come out somewhere. And then here's this parameter beta, which is the kind of the intensity which people, or the clearness of the signal they get. They get a signal about which stock is going best. If beta is large, then the signal is rather precise. If beta is 0, for instance, then they don't have any information about which stock is relatively outperforming the others, and they just pick the stock at random. So now we know how many traders are picking which heuristic, and then we have here the total demand. There's a fixed amount of total supply of shares. We've got market clearing, and market clearing gives us the equilibrium price, P. And that will give us a dynamical system, because remember, these expectations of the future price depend on the past prices. This determines then the next price through market clearing, which then feeds back of a behavioral feedback loop into the heuristics and gives us new demand schedules. Now, here there's a correction term, this constant term. You might wonder, this term might push the price into the negative region. Why is that? Well, imagine that the firm you're selling shares of is, say, a nuclear power plant. That means that if you own the firm, you have a certain risk associated to it that you might be able to pay up damages if things are going really wrong. So there is some risk associated in holding the stock. Most firms that is small, some firms that is large. So if the risk is really large, then it can be that you want to be given money to hold the stock. This is not a normal situation, but it's not strange that this price actually might go into the negative region. Questions so far?
I have a question. Yeah. So the fraction of traders, this N, is why is it exponential? Or can it also be linear or another crazy function?
It can be. This is a distribution which comes from an underlying model, which is very popular because it has nice properties. Basically, the model says, okay, we have this quantity, which is the relative performance minus the cost, and you get a signal about this quantity. So you want to pick, of course, the one with the highest payoff, but you're not exactly sure which one that is. And if the signal has a stochastic term with a certain probability distribution, then this comes out, and it kind of ties in with thermodynamics, with Boltzmann.
Yeah. Okay.
Yeah. So, but yes, you can have other rules there, and that some people do.
Okay. Thanks.
Yeah. Okay. Now, we the first thing in economics you always have to think about when you're having models about expectations, then people are always coming, what about if everyone has rational expectations? So I have to explain first what rational expectations are. If you assume that agents have rational expectations, then you assume that all agents have correct expectations of your stochastic variables. And this is an hypothesis which has gained a lot of traction in the 1970s. Basically, people say, well, people have learned already, and people that don't have the correct expectations, they're going to be outperformed in the market by those people that do have correct expectations. There's still a lot of discussion about this. And people are not really sure whether it's a good description of reality or no. And you can see that from the Nobel Prize in Economics in 2013, it was given to two people. One was Robert Shiller, which I just quoted, who said, well, no, people aren't always having rational expectations. They do their best, of course, and they will be as good as they can, but they won't have always correct expectations. The other recipient of the prize was Eugene Farmer, who's very much a defender of this rational expectations hypothesis. So in the same year, a defender and an attacker of the same hypothesis were awarded the prize, which basically means that economists don't really know the status. But I'm going to tell you a little bit more about this. Now, if there's only one expectations rule, let's call it type 0 because it's kind of singled out, then you assume that the expectation of the future price is actually going to be the actual future price that is going to be realized. And there's only one type, so your price dynamical system is going to be very simple now. Here, now we've got this future price in here, and you've got a difference equation which you can solve, and there's a one-time invariant solution, and that is the so-called rational expectations equilibrium, which basically says that apart from this risk term here, the fundamental price is the discounted expected dividend stream, which ties into how we think of dividend streams. So this is kind of the baseline, and usually in this model, everything is expressed as a deviation from this baseline price. So that we're doing this here. We're not talking about prices, but only price deviations from this baseline price. So deviation of 0 will mean that we are the rational expectations equilibrium price. Now, let's consider a very simple example of such a model. We've got two types. The first type are fundamentalists. They expect this rational expectations equilibrium price. So their expectation of the price deviation is 0. But in order to be able to compute this price, that is costly. So we also assume that they have to pay something for it. And a second is a technical analyst who just says, well, I assume that the price tomorrow will be a linear multiple of the most recent price. And this is very cheap because you only have to look at the most recent price. There are more elaborate versions of this, but they have higher dimensionality. Now, this very simple system, well, you've got a price dynamics looking here. It is a little bit more complicated than it appears because this fraction of people who are trend following is, of course, depending on the relative performance of the two types, and that is this expression with exponentials, but which I'm not going to show. But it's not terrible, but it's a little bit more complicated. And we always assume, or here we assume that there's some stochastic disturbances. Okay, and the dynamics is then looking like this. And remember, if you've got a rational expectations model, then the dynamics is just constant for all the time. Here, you see some things which we think we see also in real markets. You've got these long buildups of a so-called bubble, and then at a certain point, people are starting to get worried that they're too far away from rational expectations, guys, and you've got these sharp crashes down back to prices very close to the rational price again, and then the cycle repeats. So with this very simple model, just two types, we have this description of bubbles and crashes, which the rational expectations model can't give you. Then, of course, the question is this any good? So what people in our group were doing is taking this setup to the laboratory and see what people who are trading in such a kind of market in laboratory conditions would be doing. That was a way of finding out what happens in the micro level, because in a real market we can't see the micro level, but in the laboratory we can control things quite well. In the laboratory we see this.
Sorry, what do you mean by laboratory?
There's a room full of computers. People are sitting behind a computer. I'm going to show it a little bit more detail later, but they're sitting down behind a computer. They get a question. You are on the market. You have to make a price expectation for the future price, and then the price expectation is fed into the computer. The market rule, which I just showed you here, is then used to compute the next period price, and they are shown this next period price on their screen, and then they have to make a new price prediction.
And are they professional traders or?
No. Well, this sometimes it has been done with professional traders, but they're usually quite expensive. So it's most often done with econometric students. Okay. Who will be professional traders.
Okay.
But who are very much trying, I'll show you in a second, they're very much trying to get good predictions. Now, this looks, of course, very close to that. I have to make a caveat though. What in what we see in the laboratory experiment was the slow buildup that matches the fast crash down to the RE price, which is 60 around here, and this is 1,000, but which the experiment didn't do that well was this top here, because this was a run where people hadn't expected this behavior. They said, well, the mark, let's give them enough headroom so that they will be able to show a nice little bubble, but they hadn't expected that it would be up there. So they had instituted a maximum level of 1,000. So the agents couldn't put in prices higher than 1,000. And you see here, if you look at what the individual agents in this group are doing, the 6 agents, they suddenly find out that they can't go higher than 1,000, and then it crashes. So what happens in the laboratory doesn't validate the model for the turnaround point. But for the rest, the slow buildup, the fast crash, that it does. And in the second and third cycle, people have actually learned about this maximum here. Only one of the traders went up to 1,000, and the third one, none of them. And there's still this cycling behavior. So that means that what we see in the laboratory gives a lot of confidence of these kind of approaches with these heterogeneous expectations. The other thing you see here is that people's expectations are actually all very well coordinated. Usually they're quite close together. Sometimes you've got things like this, or here. In this case, it seems to have been, these are often typos. So people trying to make good predictions, but sometimes they just enter 0 because they put enter, press enter too quickly. Okay, now what about this rationality model, which most economists are very fond of? Does it work or doesn't it work? Is our approach the right approach, or is traditional economic theory right about rationality? And to find out about this, there's another couple of experiments which I think are absolutely crucial to understand what is going on here. They are experiments which are almost like the stock market experiments, with the only difference that here this expected price is the expectation of the price in period t, and not of the expectation of the price in period t+1, which we had in stock market. The good thing about this is that it still is very close to a stock market model if the alpha here is positive, but it's also close to a good market model if the alpha is negative. So in a good market, you have to think about how much am I going to produce. A classical example is always hog cycle market. My favorite example is Christmas trees. You have to make a decision about how many Christmas trees you're going to grow 10 years before you go to market, because it takes some time to grow. So if you grow too many, then you will have too many Christmas trees and the price will go down. So there's an information feedback. If your expectation is too high, the eventual price will be too low. If your expectation is too low, the price will be higher. So in a goods market, this parameter alpha will be negative, whereas in the stock market, it will be positive. If you expect that the price is going to go up, you lift the price and the price is actually going to go up. That's the difference between stock markets and good markets, because stock markets are basically about future expectations. Okay, so there are two treatments, one with a negative coefficient, very close to 1, and one with a positive coefficient, same coefficient, also close to 1. And this is for the experiment. There's some kind of rule. Traders are getting payoff by how well they forecast the future price. If this is 0, they get the maximal payout. And the payout of 1,300 points corresponds to 0.5 euros. So these experiments are always in such a way that if you do well, you can earn money. And typically it's a couple of, well, 22 euros over 90 minutes. Students are fond of this. Real professional traders, you can't get motivated by these kind of sums. Okay. This is what they see. So these are their own predictions. These are the real real values, and they have to match them up as well as they can. So they get the information graphically, but they also get it in numbers. And then they have here the place where they have to put in their prediction. They know what their total earnings are. They know how well they did the last period, and they've got some time to give their prediction. So this is how the experiment is working. And they're all sitting in cubicles. They're not allowed to talk to each other or to communicate in any way. They don't have a precise model, so they have to learn that, but they have heard a general story. They know what kind of market they're acting on. And this is what you see for the negative feedback market, so that market which is close to good market. Prices converge extremely quickly in almost all the cases, and of course here we get again typos or someone who got just bored because it's always the same thing and try to put in 100 for time to see what is going to happen. When we were showing this at conferences, people were extremely happy. You see, rational expectations work. This is the rational expectations prime, 60. Everything converges, and it converges quickly. So this shows that rational expectations, the rational expectation hypothesis is very good. Yes, we were then saying, but look at the positive feedback situation. There you see also that they coordinate quite quickly on the same kind of expectations, but the market dynamics has these long cycles, and they're actually far away from the rational expectations price. Here there's cycles. Sometimes they converge to it, but not really quickly. And well, here it's almost converged, but we've got 3 cycles and 3 almost converges. It's rather mixed bag, and it's nothing compared to this convergence, which is really very, very fast and very, very precisely on the price. So apparently, it is not rational expectations which is driving the price to the rational expectations price. It's the information structure in the market. So a market basically takes information about the prices and makes more information that. And different markets have different structures, and these different structures imply that there are different kind of dynamics. Now, I have a not very good, very simple model to explain this a little bit further. If you rewrite the evolution equation, you can say, okay, the prediction error is basically the expected deviation times the feedback parameter -1 plus the stochastic term. And so you've got a signal and you've got noise, and depending on the error, prediction error you see, you can then decide, apparently I'm too far away, so my XE is too large and I have to correct, or no, the fact that I'm not exactly spot on with my prediction is just due to noise. And it very much depends on this factor, how this is. So the kind of null hypothesis of an agent is, well, this is just, my prediction errors are just normally distributed around 0 with the variance of this term. When can I reject that? Well, I can reject that if I reject that, then this must really be too large, which means that my price expectation is off. And that gives you a kind of rational corridor around the rational expectations price. So if you are inside that rational corridor, you say, okay, everything I see is just due to the stochasticity. Now, if you look at these rational corridors and negative feedback experiment, they're very tightly placed around the these fundamental prices. And it's actually, it should have been 16% that you're out of this rational corridor. You're a little bit more often, but I think so. This board effect has probably something to do with it. If you're looking at the positive feedback case, so the case which is more, which is reflecting the asset price market, then the rational corridor is much bigger, and most of the time, people's predictions are inside this rational corridor, and actually it's matching up very nicely with this 84% of the time being in the rational corridor. So I don't think that my model is very good, but I think the relation gives the right order of magnitude. That in the negative feedback case, you should expect, under reasonable circumstances, people's expectations being very close to the rational expectations price. But in a positive feedback market, in an asset price market, you should expect these large variations. So this, I think, shows that no, we shouldn't, there's no reason to assume that people have rational expectations. They're just doing as well as they can. And it is the market information, the market structure, which will then determine whether your price is going to fluctuate or whether it's going to be almost a constant price. Questions so far? No? Okay. So let me go to the financial instruments. What we did is to say, okay, let's say that tomorrow the world will be in one possible state, and these states occur with a certain probability. We've got these bonds as before, we've got these risky assets as before, the stocks, but now we also have these financial instruments. The technical name in economic theory is arrow securities. They give, they're traded at some price. The total supply is zero. So if you trade them, then someone has to hold them, a positive amount of them, and someone else has to hold a negative amount of them. And they're paying out if the one state of the world occurs, and they're not paying out in any other case. So there are insurance instruments. Now we have a more complicated model because we not only trade in these stocks, but we also trade in these insurance instruments. So we get, this is now the number of stocks I'm going to buy, and this is the number of insurance instruments. It basically extends the model. So we've got demand vectors, we've got price vectors for assets and insurance instruments. We've got expected returns, but it's still the same structure. The expectation we get from selling or buying the asset minus what we have gotten if we instead would have bought or sold bonds, and here selling or buying the insurance assets compared to what we would have gotten if we would have gotten bonds. And then we've got the excess return we can then write as an inner product. We still have the traders want to maximize expected risk-corrected profits. And the risk structure now depends on the number of these insurance instruments we're offering. So that is the variance covariance matrix of the dividend stream and of these arrow securities. And that now depends on the number of euro securities which are offered in this market. Now, again, we have this assumption that the risk structure is common knowledge. So this is the same for everyone, whereas the expectations about the profits, they are based on these heuristics which might differ over agents. Well, it's again a quadratic function which we have to maximize in order to get the maximal risk-corrected profits. So the demands are linear function of the expected excess returns. We again first look at what happens if we've got a single rational trader. So we've got outside supply of assets, no outside supply of these euro securities. We get a market equilibrium at some kind of steady state prices, which is again the fundamental prices, which gives us our baseline, and everything else we will be formulating as a deviation from that baseline price. The same structure as I had before. So we've got our benchmark prices, and we have again market fractions, which are again modeled in this exponential way, price deviations. We model again the expectations of the risky asset as heuristics, as function of the price deviations, and then the demands can be written as a linear function of these heuristics. There are no heuristics for the euro securities because everyone agrees about the euro securities. We've got a market clearing equation. Basically, we get the same model as before. We get a weighted sum of these heuristics, and we see that the prices of the euro securities are the fundamental prices, because again, everyone is agreeing about the risk structure. Traders are going to the fitnesses. This is again this exponential fitness model, and the fitness measure we take is the average realized risk-adjusted profits. So the agents determine their demands based on their expected risk-adjusted profits, and they then find out whether they did well by looking at the realization. So they're consistent in the measure they're using to make the choices and the measure they use to evaluate these choices. And then there's you do some calculations, and you find out that these fitness measures are basically your mismatch between between the realization of the price and your expected price, so your expectation error, times some kind of coefficient which only depends on the risk structure, and time plus a constant which is equal for all the different traders. So it will drop out of this model because this model only looking at differences in fitnesses. Okay. So basically, the only thing you really have to know is what is happening to this factor if I've got more and more of these financial instruments. Okay. So this factor has the structure of 1 over a variance, and you can show quite easily that this variance, this risk is going down as you add more and more euro securities. And at a certain point, you can actually insure away all the risk. So this is exactly what it said on the lid. You can use your financial instruments to insure away all the risk. Okay. But if you now look at the demand, you see what is going to happen. If this, you see, demand was expected excess return. So this is what I expect to get when buying stocks. This is what I expect to lose by not buying bonds. This is my excess return. And it's divided by 1 over the risk. The risk is going down, which means that the demand is going up and up and up and up. Now, this is the thing which was missed. If you have risk instruments, the demand increases. So people are using these financial instruments to hedge away their risk, but because they've got now less risk, they say, okay, so we can bear more risk. So everyone in the system is getting more and more, is bearing more risk. So every single agent is having the same risk as before, but the whole system, the system as a whole, is having more and more risk, and that is what is destabilizing the system. So what you see here is you've got a price dynamics where basically the only thing that really changes is this beta parameter. Now this beta parameter, remember, was the precision of the signal you get about your different rules. So if beta is high, you are very well aware which rule is outperforming which other rule. The beta is very high, you're switching easily to another rule. The switches are quicker. If you switch quicker, that is destabilizing the system. Let's look again at a very simple example, two-type model. The first type, I'm now formulating it not in deviations, but in prices themselves. The first type is expecting the fundamental price with a little bias. So they don't have perfect information and they're a little bit off. The second type is a trend chaser. This is a little bit more complicated type of trend chaser. Basically, it says, well, that the price difference between the future price and the last known price is a linear function of the last known price difference. We can do an equilibrium analysis. So this is basically a bifurcation diagram. Here we've got this parameter beta over sigma n. So if I've got more error securities, more financial instruments, my sigma n is going to decrease. So I'm going to shift to the right here. X is my price deviation, 0 is my fundamental price. And you see that the steady state of this system, well, there's a solenoid bifurcation here. So here I've got a unique steady state, which is very close to the biased steady state here. Up here, I'm very close to the fundamental steady state. Here I'm unstable, here I'm stable, here I'm stable, but here I'm unstable again. So yes, there's a steady state very close to the fundamental steady state, but it's not stable and the system will not be able to find it. So by increasing the number of financial instruments, I'm going along a stable steady state. So my market price will be stable. It will be a steady state. It will be not exactly at the fundamental level, but a little bit off. But then if I'm now adding one more financial instrument, I'm going to destabilize. There's no other stable steady state where I'm going to. And there's actually a family of invariant circles, which is branching off that Hopf bifurcation, where I then jump to. So in dynamics, it's looking like this. If it's going quite quickly, actually. First, I'm having this stable steady state, and then I'm having, no, this can't be right. This must be a different value. Having periodic price dynamics, and if I'm cranking up the number of area securities, I'm getting again this typical pattern: a slow buildup, then a faster buildup, and then people are finding that they're too far away from the fundamental equilibrium, and a fast crash, and the cycle repeats again. And if you go even further, you can even also have chaotic dynamics. So this is what happens if you add financial instruments. So you're adding financial instruments, you're trying to make the system more stable, and you're actually destabilizing it. Economists like to think in terms of welfare. So if you measure the welfare as the population average of the realized utilities, you can actually decompose this term into three terms. There's the risk premium. Again, this is the idea of the money you get by holding this risky asset. There's the fact that you don't follow a perfectly rational expectations dynamics. So that's what we call the irrationality bias. Is for everyone the same. And then there's the term which comes from the prediction errors. And that term has the sigma squared n in the denominator, which means that if I add more and more financial instruments, this term is going to bigger and bigger. So prediction errors, so even small prediction errors, will become more and more important and will have always a negative effect on the total welfare. So here we computed the welfare for this same model, and you see that well, you jump up here, but in fact the welfare is going to minus infinity. This is also something which was a little bit surprising to economists, because they know that, well, if I add more and more of these financial instruments, I should be able to get closer and closer to the rational equilibrium. And this is not so. Why? Well, basically because this is a singular limit. So you don't have continuity at infinity. And this, well, this is one way of understanding the reason why adding financial instruments all the time isn't a good idea. Basically, because the whole system is going to be in overdrive, and as a system, it's carrying far too much financial risks. Okay, that is what I wanted to tell you. Thank you very much for your attention.
Thank you very much. So, do we have any questions?
I may have a question. It's not a technical question, but more like, is there then also a way to maybe with laws limit this number of these arrow securities, or regulate it? Or that's not in the model, but could there be an influence that will shift the curve up?
Well, that is very much the Holy Grail now.
Yeah.
You see, I think the underlying mechanism is quite general. You always try to find out, how can I make the financial system more stable and more safe for everyone? So you design instruments in order to reduce loss. Okay, you do that. But that means that people, when they have all these instruments, they reduce their own risk, but their appetite for risk is finite. So then they're trying to find ways to increase the risk again. Then the other thing is, almost every financial instrument has two sides. There's someone who wants to get rid of the risk, but someone else who has to bear the risk. So there's usually a way of leveraging. I think one of the answers is that you shouldn't over-distribute risk. That people just the right people have to bear the right kind of risk. And that is a hard problem to find, or to design a market for risk instruments in such a way that the right people will be carrying the risk. And yes, it's very much on the investigation.
Okay.
May I
follow up on that with a question.
Yeah.
So is it that, so I noticed that, for instance, in the expressions that you showed for risk corrected profits, I think there were some other quantities as well. There was also something of let's say penalty term that's linear in the risk, so linear in the variance. Is that very obvious that it should be that way? Is it possible that, for instance, different trader investors have different appetite for risk and will be more or less risk averse, and rather than have it exactly here, you show the this in the upper line, right? So there's the term is linear in the variance.
You mean this term?
Yeah, exactly. Exactly. So that's some investors may be more risk averse, and rather than have it linear, they would maybe behave more as if it's work quadratic or something like
that. This is, of course, a very simple model, and you can make it more complicated. This assumption is, well, first of all, there seems to be more convergence about the opinions of traders about the amount of risk than about whether it's a good idea or no to buy a stock. So the volatility is something which people agree on, but you could have a model with where they don't agree. It will complicate the analysis. Also, you could have more general expressions here. You could, but basically this measure will always have a certain degree of concavity, which means that this is always going to be the form of the second order Taylor approximation. There might be more terms here. That, yes, you can do that. It depends on the question you want to answer.
So very nice talk. I also have a question about, actually my question is about, so it seems that you're able to also predict the periodicity, right? The maximum before it collapses. So, which is of course great, right? So what now determines this periodicity? Are you able to, postpone it, and also, what sets that maximum? So for example, if you invest in the American economy, there seems to be no limit, right, to keep on investing before it will collapse.
Yeah. You see, the problem with this model is it's very much a structural model. So it captures aspects of what we see in reality. It captures very well the fact that there's slow buildup and a sharp crash. But where exactly this maximum is, that depends to a very great degree on the kind of heuristics you're admitting. And that's of course always the hardest part to predict. And if you would have a good prediction, then this prediction would immediately negate itself, because people would take it into account. And then it would shift somewhere. That's always the problem with social sciences, that your agents do read your papers. Protons don't read papers about protons, but financial agents do read papers about financial agents. So we're already very happy that we have a model that lets us understand this structure. To fit it to actual markets is much more complicated, because an actual market price is not only composed of these kind of expectational properties. Let me see. I have a actual market here, but there's also a lot of other things economically going on. So for that, you need to have first a good model of what the baseline is, what the fundamental price is. And then you can say, okay, these are deviations from this fundamental price. And then you can start trying to model these things in terms of these heterogeneous expectations models? That is a rather formidable question, actually.
Yeah. So now that this is understood, is there any hope that this will influence the number of instruments for lowering risk?
Well, basically, what has been understood, and I mean, we're not the only one having worked in this direction. What is much better understood now is that the economy is a big complex system, and that is why we are interested in complexity research at CENDEF. That this system is coupled and sometimes strongly coupled. And it's a little bit odd because the economists knew that. I mean, they were one of the first fields which had large complex models. The general equilibrium model is such one, but they focused very much on the aspect that prices can distribute information, and they forgot a little bit about the coupling in the model, and this is something which we see now. The problem is also a little bit that most econometric models assume that you're close to a steady state, and then these are second order terms. But we would argue that the economy is actually a dynamical system, and you have to think about it dynamically. But this is just an added layer of complexity, and economics is by itself already complex enough. So yes, there's more awareness, and actually this kind of research is getting picked up not so much in the economics profession, also, although there's a lot of work there too, but a lot by central banks. These people are very much interested because they've got a real problem on their hands. They want to stabilize the economy as well as they can, and they are the ones who have instruments which work on that scale. They usually are, it's usually a little bit exaggerated what they can do, but they can do things and they can influence things, and they want to understand about what expectations do. And that's one of the reasons why people in a central bank are very, very circumspect in what they're saying, because they know that what they will be saying is going to influence people's expectations, and that has a big influence on what is going to happen on the markets.
Okay, I think we've had quite a long discussion already, so we can.
Can I ask one more, maybe?
Oh, okay.
It's very speculative, so I was leaving until the end. So if you had let's say the power to establish some kind of regulation with your current knowledge of the economic aspects, what would be your regulation on these financial instruments? What would be your choice, or how would you go around it?
Well, there are a couple of problems here. One problem is, of course, globalization, that all these markets are linked, and that more or less everyone is trying to do the same things. This is not something which can be regulated away. There is a lot of discussion about introducing taxes on trades, so-called Tobin taxes. It is not clear theoretically whether that's a good idea. The idea is that if you stop trade, then people will take out less bigger positions, and they will trade not as quickly. I could imagine that this very fast trading rhythm is one of the problems. What we don't know yet is how far these kind of regulations might distort market prices. I could imagine that something along those lines might be beneficial. But again, it's not clear. One of the things which is really a problem is that many of these trading banks are too large, and what we see is that they didn't have to pay for their losses, because people let do that with one bank, and that was the trigger for the whole financial crisis. So I think if there's regulation, it should be on the kind of losses and gains and risk exposure which you allow these big trading companies. And there, I think there's a lot of things to be done, because you shouldn't forget that all these big companies are publicly traded companies. They're stock companies, so they can be regulated, because they are assumed they're assumed to trade with publicly available stocks, so with the money of the public. And for that, I think the public could regulate them a lot more than they're doing right now. How this has to be done, I'm not sure. The other problem is that even if I were sure, there are big lobbying forces in that field. So I don't know whether I would be able to actually change something. If there's going to be a change, it probably has to originate in the United States, because if you do it in a small country like the Netherlands, and it is very hard to have a regulation that makes it beneficial if you only apply it in one country. You have to apply it worldwide. So the problem is mainly one that things have to be done by everyone at the same time. So you have a solution which promises to everyone that people will get better. Yes, what that solution is, I don't really know. Probably the next financial crisis will tell us more.
Great, thanks.
Okay, so let's thank Florian again for a lovely presentation.